Okay, good morning, everyone. Thank you so much for joining us today. We have Chris Bettis here, who's from Fluent Mortgage, going to teach us all about credit, which is good for me this morning. So Chris, go ahead and take it away, and we'll make sure to work with you on the chat feature so you get your questions right away.
Awesome, thank you. So happy Friday, everybody. Hopefully you're on the right webinar, so 2 hours on credit. If that's what you're not expecting to hear, jump off now. So it was advertised as Credit 101, 102. I call the course Credit Puzzles and Solving Them. Let's go. All right, so something unique to COVID, lots of things, right? One of them though is would typically be doing this live, we're using Zoom, and usually, I don't know if you took Toastmasters, whoever's presenting, they talk about them, right? They not only introduce their name and where they work, but why you should even listen to me. Am I experienced enough to be teaching you today? So in the new normal, I guess I get to brag. So I'm gonna brag for a bit and tell you why I'm smart enough for you to listen to me for 2 hours. So credentials, awards and certifications. I was awarded NAM's Mortgage Professional of the Year. I was voted by the peers, the entire nation. Equivalent would be NAR's Realtor of the Year, right? Just a popularity contest. It was still cool. NAM's President Award of Merit in 2018. So the president of NAM said, hey, you've influenced the industry more than anybody else the entire year. That I was impressed or proud of that. Certifications, certified veteran loan specialist, certified mortgage consultant, certified residential mortgage consultant, and a certified Oregon Association of Realtors GRI instructor. So at least for today, there's no one higher certified than I am in the state. I'm sure you've met people that can teach but can't produce. Nothing against teachers. My grandparents were both teachers, but I throw down a little bit too. So in the last 2 years for multiple lenders, we've been top 1% in the nation, 2019 and 20. In terms of some real numbers, in 2018, did 269 transactions and over $61 million. So it was a good year. In terms of service, I've been chapter president, state president, on the national level, executive committee, secretary, government affairs chair, regulatory affairs chair, and my favorite position so far, and I am this year, is tech chair. So I get to work with the software owners of the top software companies throughout the nation, and we're building an ecosystem for mortgage. So it should be a really, really fun year. And then probably the most important thing to me, more than accolades, more than accomplishments, is relationship. And that's my wife, Michelle. We've been together for 28 years, and we have 2 daughters, Rose and Hannah. In terms of my hobbies and me, my passions are fitness, grappling, and motorcycles. So the more adrenaline, the more type A it is, I probably like it. So that's me. Hopefully you think I'm qualified to teach you today. So welcome.
So Chris, just to jump on here 1 second, you're much better with tech than I am. It was pointed out to me, so we can see your slides across the bottom as well as the next slide up. Is that how you want us to be able to view it, or are you wanting just to...
That's not usual. So let's do this. Thank you for saying that. Instead of presenter view, I'll just play from current slide. Let's see if it does it. Yeah, unfortunately, for whatever reason, PowerPoint, it should not be showing that, but it is. So let me try this. I'm going to share a different screen. We're going to share desktop too. How about now?
That's better.
Yeah, that's
okay. Good. Here, and so for me then, though, it's not showing my presenter's view anymore. Awesome. Okay, so now it's just a big screen of today's agenda, correct?
Yes.
Yeah, thank you so much, Beth, for saying something. So, all right, so here's the agenda for today. And just so you know, we're gonna run 2 flights, okay? So I don't know if you saw all the people that are on today. We've got some really new people. Thank you so much for being here. I promise I'm gonna lay a foundation to credit, so a house analogy. We're gonna just set a really strong, solid foundation for you. And so for some of you, I've seen, you're giants in the industry, you've been around for a long time, you're gonna be like, I kind of know this. I'll fill in a couple holes, make sure your foundation's solid, but I promise I'll bless on you, love you a little bit later. And so for new people, we may go a little high level at the end that you're like, oh my gosh, I'm not understanding everything. That's okay. Remember, 2 flights, right? So we're gonna do a really advanced flight and then a foundational flight. So Credit 101. I'm then going to unveil the keys to the kingdom, show you something most of you have never seen. And that's literally live rates, where rates come from, the difference in rates, and how, depending on the lender, the influence that can make. Right after our quick break, we'll look at the new stuff, all the changes in 2020, 2021. And then finally, I'm super excited to do a case study in rapid rescoring. So one of the most valuable tools in a market like we have today. Okay, so that's the agenda. All right, has anybody ever heard me speak, either in person or on a Zoom call before? Please raise your hand electronically, say yes, yes. Okay, a couple people. Awesome. Hey, welcome. It's nice to see you all again. If you haven't heard me speak before, no matter what class I'm teaching, same 3 goals no matter what, okay? 1, that you learn something, that I put more knowledge in your brain, right? That I empower you, that I give you more than you have before in terms of intelligence. That's the start. More importantly, though, in my opinion, is that you do something because of it. I'll let you learn from my pain. 2 times in a row, I went to a national convention. I took a week off. I spent lots of money. I got to listen to the best of the best. The people that do 269 transactions in a month, not in a year, right? We got to do game plans together, like so jacked up, learned so much information. And unfortunately, 2 years in a row, made no more money, closed no more transactions, did nothing more because I didn't implement. I didn't put it in my game plan. I didn't do something about it. So what I challenge you today is at each kind of stage, you say, hey, based on what I just learned, how do I implement this? Who am I going to talk to? How am I going to do business a little bit differently? That's how you're going to make more money. That's how you're going to close more transactions, help more people, more units, finish #1 in the rankings, control time, retire early, whatever your goals are. And then lastly, can we commit to having fun? Wow, I don't believe anybody on here is gonna have fun but me. Can we commit to having fun? I know it's mortgage, I know it's CE, and especially the super sexy topic of credit. I know, but I need the energy back from you all. So I promise to give you everything I have and to make it light at times and funny, but I need some energy back, all right? So let's have a good time. All right, the perfect day. If this were live, we'd actually usually dim the lights, we turn them off. So what I'd like for you to do is mentally and emotionally think about the last time you had a perfect day. What was the day like? What did it feel like? And so what I'd ask you to do to start is just close your eyes. We're gonna take a couple deep breaths in and out. So deep breath in. Another one in. Out. Okay, so just imagine you're laying in bed. Feel relaxed. You're like, oh my gosh, did I sleep through my alarm? I've been laying here forever. I've gotten so much sleep. You turn over, you look at your watch, your phone, whatever it is. Wow, I have an hour left. You turn back over. A little while later, you're like, I just can't sleep anymore. It's been so long. And you look 20 minutes to go before your alarm even goes off. I'm just going to get up. Can't do it. So go ahead, just open your eyes, right? Man, I'm so well rested today. What a great night's sleep. I don't know about you, but I don't get enough sleep usually. I'm that person. One of those days. Today's going to be a good day. And I'm not sure what you do next, whether it's coffee or tea, hot tubs, sunrise, how you kind of start the day, whether it's reading and prayer or meditation, whatever it is for you. What a great morning. Coffee. Perfect balance of sweet and bold, like the right temperature, right? Like today's going to be a really good day. You have peace, mentally, emotionally, spiritually. You're ready to seize this day. Next, I'm not sure about you, but I work out. Whatever it is, I need to get myself physically ready, right? And so you're in the gym, and I don't know if you're doing spin classes and you just went faster and harder than you ever have. If you're lifting weights, you hit a couple PRs, like you're just loving it. Like today is a great day, right? You're feeling it. Outfit, dialed, hair, makeup, looking good, like you are a beautiful human being, like you're realtors, right? You're beautiful people. So, and you know, when you look good, you feel good. And when you feel good, you have more confidence. And when you have more confidence, you're more successful. That's today. You're rested, you're excited, you're ready for the day. You look and feel great. Feel that? You've had those days? That's today. Today's going to be an amazing day. The other reason why you're so excited and so jacked up, oh man, today's the day. You're going to close that transaction. So if you're brand new in the business, it's that first transaction. Remember, they've said, you can't do it. You don't know enough people. It's too hard. We're in a recession. You missed your chance. Today's the day. You did it. You made it. For those who do it part-time, right? You have your full-time job and then you're doing this real estate thing. You closed a couple transactions. Today's the day you get to go full-time. When you close this transaction, you get to quit that other job. You're a realtor. Today's the day. You feel it? You've had those days, right? For you, been in the industry for a couple of years. Today's the day you get freedom. Today's the day you capture back time. You get to hire a buyer's agent. No more weekends, no more evenings, no more 5 o'clock on Christmas with a call saying, can you show me a house right now? Today's the day you get back your life. Or, and I've seen some giants in the industry on here, today's the day you close that $2-3 million transaction. Biggest one ever in your career. You're gonna make 40 to 60 grand today. You actually get to take a vacation for the first time in a couple of years. You're gonna take a whole month off, right? Or you get to semi-retire. Today's the day. Have you ever had those days? The perfect day? Yeah, me too. Today so far for me has actually been a perfect day. It's wonderful. So in addition to that, kind of like the picture on the screen, see how it's beautiful, it's sunny, right? Remember this last Saturday? Just a gift, just a blessing. I don't know about you, but you walked outside and it was literally immediately sunny. Not a cloud in the sky, right? Like it was literally warm. You like took off your coat and threw it back in the house. You're like, oh my gosh, it's gonna be 70 degrees. That's today, okay? So you feel good, you look good, you're excited, that's today. Now, I hope you have a Jeep Wrangler. I hope you have a convertible. I hope you have a motorcycle or something and you're out enjoying the day, right? So you're about to go to the signing. You're going to that transaction. Today's the day. You're rolling, you get in your car and your jam comes on, right? You're feeling it just building more and more and more and more excitement as you're going to that transaction, the closing. And all of a sudden, ring, 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 ring. Oh, great. It's the banker or broker on that transaction that I haven't heard from in a couple of days. I've been trying to reach out to him. Pick it up. Hey, Mr. Banker, how's it going? Wait, hold on. Are you going to the signing? I know I'm headed there right now. You're going to be there with us? No, you're not going. Okay. Wait. I don't understand. What are you talking about credit? Okay. So you pulled credit today because you're closing. Sure. Credit scores dropped. I don't understand. Bottom line, what happened? It's not going to close. I'm sorry. They took out new debt. Dead. Transactions dead. It's not going to happen. How's your perfect day now? This is real, right? This happens. If you've been in the business, this happens. And I know it's a funny picture. This is actually a photo of somebody about to get in a real car crash. So if this happened to you, perfect day, that transaction, a banker broker calls you and says, dead. What do? Interactive. Go ahead, unmute yourself, call it out. What would you do? Comment on it. Cam can say what they said. What would you do if that happened? All right, well, I'll tell you responses. Since nobody's sharing yet this morning, you got to get warmed up a little bit, right? So I would cry, logical. I would swear at anybody I could see. I'd drop F-bombs. I'd throw up in the passenger seat. The most extreme, kind of like this guy, he's like, I would find the nearest thing I could drive into and I would hit it. I would go into a telephone pole. I would go into a house. I would crash into something. That's a little extreme. So, but that person really tried. So good for them. He's an overachiever. He put his car on top of the house he was supposed to have a listing appointment on. So good job. Probably not the smartest way to get that listing, but it works. So that's real, right? So if you haven't been in the biz that long, it's not an if a transaction is going to fall out, it's when. And what do you do about it? Statistically, 24% of all transactions don't close. They don't get to the finish line. Almost 1 in 4. So those 4 little people, one of them's not going to make it to the end. I don't know how you feel, but that makes me angry. It should not be that high. There's no reason for it. And since it's an average, that means some of you are losing more often than that. Some of you are better, but some of you are worse, okay? In my humble opinion, it should be around 5%, 6% max. So what we're gonna do through this course is give you ways that when you hear no, you can turn that no into a yes, okay? But what I want you to get more importantly, because a lot of realtors leverage the no into yes, right? But you can turn yeses into better yeses. And it's such a competitive market, appreciating market. Sorry, phone went off. I just disconnected it. It's an appreciating market, right? Every dollar we can get. So I'm going to show you how to turn almost could buy into can buy a lot more home. Okay. So you can see a three-legged table here. This is basically lending. Imagine a three-legged table, right? And if that table stands, your buyer gets a transaction, gets to buy a house. It's lending. Okay. So there's three legs to it. If you look at the screen, the first leg is credit, and we're going to spend plenty of time on credit. Okay. So you'll have that leg down by the end of today. The next leg is collateral. That's the property that they're buying. So, and again, just imagine if the table stands, they're going to get a loan, right? So on the collateral, is it stick built, the most desirable? Is it manufactured? Is it a dome home? There's one that's been for sale forever towards the coast, right? Is it developable land? Is it non-developable land or developed land, right? So depending on the type of property is stronger or worse collateral. So that could be a shake or weak leg. How much money they're putting down will determine if that's strong or not. Lastly, capacity. Do they have the ability to repay it? Self-employed like us makes it a little tougher, but do they have enough money to pay back that loan to debt service? All right, so that's the three-legged table, right? Now, here's a little insight into layered risk. Has anybody in here ever had a transaction that was approved at the beginning? The table stands, we have the thumbs up through Freddie or Fannie, and then towards the end, the underwriter says, no, it's dead because of layered risk. Has anybody ever heard of layered risk? Anybody? I can't see the hands up or comments. Cam, can you see it?
No one's jumping in yet.
No one's jumping in. Okay, so it's what layered risk is. I'm surprised you haven't. It's probably that time where they're like, I don't understand. It should have been approved. It all made sense. And now we're hearing a no. You just hear a no and not the lie. So using that three-legged table analogy, imagine if credit was shaky, right? But the table stands. It's just barely good enough to get approved. But it made it. If you had a table with two solid legs and a shaky leg, it stays. But imagine the collateral's funky too. So it's a dome home and they're putting the minimum down as well, right? Dome home, shaky credit. I got a table with one solid leg and two wobbly legs. It's not the most stable table, but it's still standing. But imagine if their ability to pay was also shaky. So if you ever had a table with three shaky legs, right? It just doesn't stand up. So that's what layered risk is. So if you ever have a lender tell you layered risk, it's all the legs stand, but when an actual person looks at it and sort of puts anything on the table, it just falls over. All right. Any questions on that real quick? I'll go past and we really dive into credit specifically.
Was character one of the seeds, one of the C's back in the day?
Yeah, so character really is a part of credit. So yeah, so you could say credit or character interchangeably. Good question, Cam. Credit, it's an example of risk mitigation or character. And so you're kind of stealing my next slide, but okay. But great question.
That was a great question from Kathy Ging.
Oh, thank you, Kathy. So here's an example of a credit report. Happens to be Credit Plus. Thank you for a lot of the stuff you provided today. So I can have privacy policy and not share somebody that needs it. So this is Joseph test case, a fictitious person. And so there are three credit reporting agencies. There's Equifax, Experian, and TransUnion. Now, for you all, what's going to affect us the most is Equifax. That's the West Coast. So for most things, autos, credit cards, whatever, it's just going to be your Equifax. But for mortgage, all three are potentially important. And we'll dig in a little bit. So pop quiz real quick. So please use your chat. Let Cam know. Here's an example credit score, three of them. What score would I use for mortgage? So go ahead, type it out right now. What score would I use for a mortgage? The Cam, as they put it in, just start calling out numbers if you would, please.
A lot of the 622s so far,
Okay.
all three, the lowest.
Okay. And the highest. Okay. So great job, everybody. So we've got the lowest, which feels like mortgage, right? We've got the highest, which would be very optimistic. And then we've got the middle. So just so you know, we use the middle credit score. So in this case, 3 scores, the middle score would be a 622. So whoever got a 622, you get a smiley face or a hug from Beth or Cam next time they see you. Good job. He shook his head. Yeah, he'll do it. All right. So this happens sometimes, and I still can lend on it. Sometimes there's only 2 scores, right? So again, use your chat. I got a 614 and a 627. Now what do I use for a middle score? All right, Cam, as numbers come in, what are people saying?
614, lowest, average of the 2.
Okay, so smart, first average of the 2 we've gotten in a while. In this case, unfortunately, it's going to be 614. So since there's no higher number, we go off the lower of the 2. Nice job. Most of you know all this. Great pop quiz. Now, lastly, okay, so I've got a husband, and typically, not to be sexist, but typically us men, we have lower credit scores than most women, whatever, statistically. So here's the man score. He's a 622 middle credit score. And then the spouse, happens to be a woman in this case, has a 763 credit score. Both of them are on the loan. Both of them are buying a property. Which one do we use? 622 or 763 or somewhere in the middle? What are we getting, Cam?
Some 622s.
Only?
Somewhere in the middle.
Okay. So unfortunately, we use the lower of the 2 credit scores. We don't get to average them. It doesn't matter what the better person is. It's the lowest common denominator is what we use. So we use middle credit score, the lower of the 2. Okay. So for principal brokers, I know as we're trying to troubleshoot, I've had this happen so many times where someone says, hey, it's okay, there's 622. Dad said he'll co-sign and he's an 800. I'm sorry, that doesn't get rid of our 622. Okay. All right. So why do we use credit? It predicts risk. Really what's trying to predict is whether or not you're going to pay me back if you're the borrower. Are you just going to completely default, have to send you to collections or judgments within the next 2 years? That's really what it's trying to predict. Are you going to pay me back? Right. And if I was borrowing money from you, that'd probably be a pretty good thing to know. Right now, credit ranges from 300 to 850. So, and the higher, the better. So unlike golf, I know a few of your golfers, we want high scores. So you want that 800 credit score. In terms of what I've seen in about 10,000 reports, I've never seen a 300. You have to work really hard to get in the 4s. Like you really have to try, but I see a 4s probably once every 2 months. I see lots of 8s though. So just so you know, kind of statistically. So even though there's 40 different factors in the matrix that influence the score, really for real estate, because you're not credit repair people, you're not mortgage people. If you really learn the 5 major buckets, you can keep your credit good. You can help advise your clients. We'll dig into one of them a little bit, but really you're going to have a fundamental understanding of credit. Okay. And so on those 5 buckets that we're going to look at, and we'll dig into them each, but performance is more than a third of it, 35%. Utilization, this is the coolest one. We're going to spend a lot of time in utilization, and that's the one we can influence for scores. Type of history, what type of credit you use, and then finally inquiries. Okay, so 35, 30, 15, 10, 10. All right, so payment history, 35%. We're going to use this analogy throughout this whole 101 part. Just pretend I borrowed money from you. So Cam, hey, can I borrow $100 from you? Is that cool?
You got it.
And because Cam and I have known each other forever, Cam's like, sure, I'll do it. He's like, but just so you know, Chris, I'm a little, and this isn't really Cam. Cam's a very successful person. I'm just hypothetically saying he's really poor right now. Okay, so please don't be offended of me. Cam throws down. So, but let's pretend Cam's super tight. But because I asked him, we've been friends for so long, he's like, dude, I'll let you borrow the $100. I know you need to pay your bills. He's like, but this is my daughter's soccer season. Like, this is her registration. This is such a big deal to my life and her life. I'll let you borrow it. But you have to promise me you're going to get it back by the end of the week. Yeah, sure, of course. Well, whether or not I pay back Cam is more important than anything else, right? So same thing with payment history and credit. How your clients pay their bills, nothing else can impact more, okay? Nothing else. 35% of scores, whether or not they pay their bills. And kind of like relationship with Cam and I, pretend I didn't pay him back, right? And his daughter didn't to do her favorite sport. She's been emotionally like not good because of it. Like she was supposed to have scholarships and her daughter didn't get to play because of me. Well, the first 6 months, just like with credit, he's probably going to be really pissed off at me. We probably shouldn't see each other, right? In the near future or in the near past, like he's probably going to be really mad. But after some time goes by, and in terms of credit specifically, from 7 months to almost 2 years, there's less of an impact. It'll still impact the score, but not the same. And kind of like Cam and I, after it's been like 6 months, she's in a new sport now. He's like, man, Chris really did do me dirty, but we've known each other so long. He was just in a bad state. He's still not happy with me, but some of the emotions subsided a little bit. And then after 2 years, he's kind of forgotten about it, right? Very little impact after 2 years. Now, right here on the bottom, you can see how often and how bad also affects the score. So let's use that same example with Cam. Let's say it's only happened once, right? And I've borrowed from Cam and we've borrowed back and forth for decades. It's like, dude, he's always paid me back. Man, I know he just got hooked on crack for like 3 months or something. Not really, I didn't actually. So just in case, don't start a rumor in the industry. Chris Bettis with Fluent Mortgage is hooked on crack. It's not true. So Cam's like, dude, it was a low moment. It hurt me, but hey, we've always paid each other. We're solid. But if every time, like say 6 or 7 times in a row, I've done him dirty, right? Over and over and over and over. He's like, no, you're just not a good dude. You're just a liar. Don't pay me back. If I consistently did it, he's going to say, sorry, I'll never lend to you again. You're a poor character. So that's the same thing on credit. Life can happen. If it happens once, a little bit on score. But if they can see a track record or trend or history of poor character, your score's plummeting. Okay. So pro tip, in case you didn't catch it, nothing can make more impact. So there's sometimes in the transaction, we'll have conversations. I've had borrowers tell me literally, hey, we're a little tight right now. I know they've talked about how you don't have to make payments at all, because of COVID and that, not being political. Truly, this is economics. This is just real estate. Okay. I know it's a sensitive subject for people. Just economics. But they can pay their payments. You're like, dude, you have to make your payments. I'm sorry. That's a character issue. Your score is going to drop. There are ramifications. Please keep your word. Now, obviously, there's forbearances in certain programs where there's a lot of people really hurt. But if you can make your payments, you got to make your payments. So sometimes I've heard in mid-transaction, like, yeah, we're just not going to pay a couple credit cards because I want more of a down payment. No. Make your payments. You're going to destroy the transaction. You're paying your bills. Any questions on making your payments, performance at all? Yeah, cool. Balances. Did you shake your hand? No. Was that a no or a yes? Or you just gave me the
no questions.
Right. You're still mad that I didn't pay you back your $100. I get it.
I'll figure it out.
I gave you the finger just so you know. So balance is 30%. So this is called utilization. And we'll look at a visual in a second. But bottom line, how much do you have available versus how much you've spent? Okay. So common buckets, 0, 1, 30, 50, 75, and 100. You don't have to memorize them. You're in real estate, right? Oh, and by the way, Beth and Cam and Cascade are recording this. So there's going to be an internet copy of it. So if you ever want to go back for reference, the entire presentation is going to be online. Additionally, if you're note takers, any of the slides I'm going to give to you. So if you want to copy the slides, just email me personally. I'll send the PDF copies of it. You don't have to take notes on slides. If I say something witty or someone else jumps in and gives you a gem that's not on the slides, please make note of that. But this is all blessing to you from Cascade and us. And revolving debts impact your score more than installment debts. So just so you know, if you get a brand new car loan, you only influence score on the first 10%. So paying it down below 90%, no impact on score. We're talking about utilization on your credit cards, and that's what we're going to play with later. Okay. So here's an example. So, and a pro tip and what I mean by utilization. So look right here we go. So right here, so as an example, we're pretending, well, Joe Sample has $25,000 of credit card debt available to him. That's his high credit counts.
I'm having trouble hearing you.
Be quiet, Siri. All right. Siri was jealous. I wasn't talking to her all morning. All right. So $25,000 available to him, and he's used $4,000. So he's borrowed $4,000. He has 25 available, right? Here we go. Back to that. So 4 divided by 25 means his utilization is 16%. He's used 16% of his high credit limit. Okay. So remember, that's a pretty good bucket, right? We want to be as low as possible, for sure under 50%. So the first thing they do is they look at all of them as a whole, but then they go line item by line item by line item, creditor by creditor by creditor by creditor. Okay. So in this case, one of his trade lines, one of his credit card accounts is at 80% utilization. So even though his utilization overall is 16% and 0.0000, one of them is really high. So there's 2 different strategies. Please understand the why. So if your or your client's goal is to get out of debt, you're going to use the top strategy. Okay. So what you would do is you would go after the first debt and you knock that one out. So if you're trying to get out of debt, we knock that one out. And then we take that extra $200 a month and we apply it to the next one. And then you're paying $400 a month at it, right? And you knock that one out. And then you go to the next one. And now you're paying $600 a month to the next one. So not only do you statistically get out of debt quicker in that method, but emotionally you're like, yes, I'm down to 2 cards. Now I'm down to 1 card, right? You win, you can reward yourself a little bit. So if you want to get out of debt, if the why is this, no transactions, not buying a house, this is how we play the game. Get yourself out of debt, get yourself. And now with this, we're throwing, $1,200 a month at this card, aggressively paying that one down instead of $10 at all of them extra, like a lot of people do. Now, if we're buying a house, if we want to have more leverage, if we want a better credit score, then you want to take that $4K in advance of buying a house, right? In advance of me pulling the credit score. And we're going to push it around. We're going to move it to 1,000, 1,000, 1,000, 1,000, right? So that way we're at 20% utilization on all the cards. So same 16% overall, but you're actually going to raise that credit score a tick because of utilization on each card. Does that make any sense? Any questions on that at all? I know for some of you, this may be new. Utilization, this pro tip, again, a little bit higher level in terms of what we've been doing. Anybody have any questions on this? Nobody can? Cool. I must be doing really
info, yeah.
Okay.
Can you hear me?
Did
Can you hear
say
me?
something? Yeah.
Can you hear? Okay. I have headphones on and I don't usually use them. So what I'm wondering is, does this also do student loans factor in a similar way as, say, like car loans, or are student loans sort of in their own realm?
Okay, great question. I'm not going to avoid it, but we're going to kind of talk about types of debt here in a little bit later. So
Okay.
Wonderful, wonderful, wonderful question. Yes.
Okay.
So anybody else real quick before we move on out of utilization? And we're going to spend a lot more time on this. So when we go to the advanced section at the end, we're going to dig into this hard. So, all right, credit history, how long you've had your accounts. So as an example, let's go back to me asking Cam Moneybags over there if I can borrow $100, right? So let's pretend I met him yesterday and we had coffee, right? He came to the office. I'm like, hey, bro, can I borrow $100? He's like, no, I just met you. No, I'm not giving you $100. No, you're just some mortgage guy. No, right? Like that. Same thing with credit. If someone just opened up a whole bunch of accounts, they're like, we're a little afraid of you. You've never carried much debt. And now all of a sudden you have $100,000 of credit card debt, brand new. We have no history. We have no track record on you. And so, but imagine if Cam and I, again, have been friends for our entire lives and we've done this back and forth, back and forth, back and forth. Cam always pays me. I always pay him. That's a good history. He's going to be much more likely to lend me money. Same thing. So with new accounts, you're going to have a lower credit score. If we've seen accounts for 20, 30 years, you're going to have a much higher credit score. Okay. Credit history. Now, the one thing I would say is be careful, especially if we have some people that aren't as technology savvy. I see a lot of old accounts falling off sometimes just because of inactivity. just make sure you pay your $50 renewal, or you at least use it once a year. Do something with those just gold accounts with $30,000 and $35,000 balances that you've had forever. Like, those are treasures in gold. You can't let them go away. And again, as friends here, actually, I'm going to go back a bit. To use an example of me, I was so dumb before I got in the industry about credit. I had no idea. And I had a really good credit score. I knew you had to pay your bills. But just like this one, I had $25,000 available to me. I had $4,000 against my credit. So I was this exact, except it was this. I'm literally this person here, right? 1111125. Great credit score. So me and my brilliance, and credit isn't common sense if you don't understand it. And my brilliance said, hey, I just got a 0% credit card offer for $4,000. Guess what I'm going to do to help my credit? I'm going to take out that credit card. I'm going to move all $4,000 that was spread out into one card. I'm going to close every other account, so I have one brand new card that's maxed out. Guess what happened to my credit? Yeah, it plummeted. Again, I thought I was showing them that, hey, I don't even need that much debt. I'm so good. Look at my track record in history. I have even less debt now. That's not how the game is played. Again, understand it. Understand. All right. So credit history, how long you've had it, how long you've been friends. Pro tip, again, using my example, when we pay down those accounts, that's awesome that you have zero balances. That's awesome you leverage 0% interest rate, right? Remember that getting out of debt? I did the right thing, except I shouldn't have closed those other accounts. So we want between 3 to 5 revolving accounts left open. Again, they have all the same interest rates. What has the biggest account balance and has been around for the longest? If let's say you have 10 or 15 different accounts. And please only open accounts after running a simulator, a what if simulator. And we'll look at what that is later. So in case I see some people give me like, what's a simulator? So we'll look, I promise. All right. Last, please, 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 as a team, help us. Like, you know, there's certain times you'll ask me, hey, reiterate this to my client. He needs to get his earnest money in. He keeps not listening to me. We're going to be out of contract. Can you please support me? Well, same thing. And a lot of times you have more interaction than we do because we're digital end to end and they create a relationship with you. Just please counsel your clients. If you hear them talking about saving 10% at Kohl's to get some appliances, like, no, don't do it. I've had people buy brand new BMWs, like roll into the closing. Like, I hope you can sleep on that thing because you're not getting a house now. Like, what the heck? So just sometimes as you hear stuff, please advise them. Again, no appliances, nothing for the house, okay? Not until after you own it.
There's a quick question. Do credit cards count towards the revolving accounts, or does that include car loans, mortgage, student loans?
Great question. So by definition, a revolving account means you can borrow against it and borrow and pay it down and borrow and pay it down. So auto loans or installment loans like a home loan, those aren't revolving accounts. Those aren't credit card debts because as you pay it down, you no longer can borrow that against it. So wonderful question. We're talking about lines of credit, credit cards, those sorts of things. All right. So inquiries. Up to 60 points, so 10% of your score is inquiries. Only hard inquiries affect you anytime you're applying for debt, basically. If there's new debt, it's a hard inquiry. You look at it yourself, doesn't count. Your insurance agent, anything that's relational, it doesn't count against you. That's a soft inquiry, okay? 12 months. So credit inquiries stay on your report for 12 months. Oops, we went the other way. How? All right, so consumer credit, revolving credit, any of that little debt, 3 to 7 points is what it's going to drop your score statistically on average. Mortgage and autos are from 5 to 15 points, just be aware. But the cool thing though, is for 30 days, someone else can run another mortgage credit pull and it not affect their score. So for example, if someone pulled their credit with Veterans United, USAA, less than a month ago, I could still look at it, you could see, and you can shop. So at least in real estate, they've got a month they can shop a little bit. So be aware, okay?
A couple questions popped up here.
Yeah.
In the scenario where you're opening a new account and your scenario where there's the credit scores of a couple, how impactful is the higher credit score person when they open up an account?
Okay, so Well, remember we're going to use the lower credit score. So I think what we have is someone being really smart and figuring out how to leverage something, saying, hey, if we have to open an account, so here's I think what they're trying to point to. Yes, if I had to open an account for some reason, and if my score were crazy high, I would be the one pulling my credit, not the one that's marginal, right? Because who cares if I drop from an 830 down to an 825? I'm top tier. But that, that 642 will drop to a 635. I'm like, oh my gosh, that was catastrophic. So wonderful question. If you have two people and you have to pull credit, you can leverage just one because we're not in a community property state. So wonderful question.
There's one more going back, but I think it's on using the card. So is it monthly? Can you use it, pay it off, use it again in the same month?
Yes. So I won't steal it now, but it used to be a huge deal before, but because the new Fico 10, you'll see why it's not as impactful today. But we'll look at that in a second. So great question too. All right. Okay, so some quick fast facts. So paying off does not remove your history. So as an example, let's say you just had poor payment history, you didn't pay a certain credit card, you're like, oh, that sucks, my credit score dropped. Just because you paid it down to 0 and closed the account, that track record isn't good still. So kind of like with Cam and I, just because 8 months later, I'm like, Cam, I'm so sorry, here's the $100. He's like, well, I'm glad you finally paid me back, but my daughter still didn't get to play soccer. Right? It doesn't negate the fact I didn't show character to Cam. Okay. Credit accounts, if you pay as agreed, they'll stay on your report for 10 years, a really long time. If you have a bad payment history, so like me and Cam, he'll remember that for 7 years and then he'll forget. Okay. Collections. If you have clients with collection, yes, Cam. You're muted. You're muted. I can't hear you, Cam. You muted yourself.
Nice. So one more on that. What's good advice for people who pays everything in cash when they decide to buy a house and they realize they don't have any credit?
Oh, wonderful question. We're almost there. I have a slide specifically on that. So it's going to be in the 10T. So yeah, so you can tell there's some people that have been in the business for a while that have run into scenarios that like, I got you. Thank you. So collections we run into all the time. Just be aware, again, like I just paid, we'll go back to the analogy of Cam and I, right? So imagine 8 months later, I'm like, Cam, here's that $100 back, right? So at the 8-month mark, remember, it started to heal a little bit, right? Like that wound on his arm had scabbed over. And so even though it's a good thing, even though long-term relationally, Cam and I would be better by me paying him back 8 months later, it kind of opens the wound, right? You kind of ripped off the scab, to use a gross analogy a little bit, right? It's bleeding, it hurts a little bit, but it's really going to be good long-term. It's going to heal. So that's the collection. When you pay it off, it brings that wound fresh and the score will drop a little bit. So here's the pro tips. Let's just do it through escrow. Don't let your clients pay in advance. I shouldn't let them pay in advance. We just do it through the transaction. They're going to come in with their 5% down plus the collection, right? And then their score is going to drop a little bit post-close. Who cares? They bought their house. And then it's going to start improving very quickly thereafter. But we want that drop to occur after they bought the house, right? So if you have to close accounts, again, use the what if simulator. You'll see it in the future, but don't let people close anything without talking to us first. Collections and tax liens, 7 years on your report. Judgments are for 10 years and they can be renewed for another 10 years. So that not only hits the credit, but usually your prelims. So you know how sometimes you're like, I'm not going to pay it back. It falls off in a year. Maybe, but if they want to, they can renew it for another 10. So you may not be able to buy a house for another 11 years. You just sold a house. It's only $1,000. Can we please just get it paid off so you can buy your next house? Like, what are we doing here? Bankruptcy, Chapter 7 and 13, 10 years. But after 7 years, you can ask for it to come off your report. Sometimes it will. And tax liens are forever. Like the IRS, they're going to get their money. It never, ever, ever goes away. All right. Any questions before I kind of wrap up this section for the most part? Okay. So here's the cool thing about credit. Well, negative first. 1 in 5 people have something completely wrong on their report. I did on my first house, a Christopher J. Bettis, I'm a James. His bad credit hit my credit report at the very end on a credit pull. A judgment showed up, it hit the prelim. We had to fix it. Kind of stressful at the end. But here's the exciting part. 80%, 4 out of 5 people can have a better score. So 4 out of 5 times we can turn a no into a yes. Or more important today, and I hope you'll get this again, a yes into a better yes, a 400,000 into a 450 buy, a 500,000 buy into a 600,000 buy because of credit. Just 1 point sometimes can get you 50 grand in your house. Quick notes for products today. So in general, you need at least a 700 FICO score for construction loans, rehab loans. 680 and above, we're going to look at conforming lending, just Fannie, Freddie, how most of the financing is done. Even though the rule says no minimum FICO score, and I know I'm rapid firing these at you, you'll get the slides. These are fun, fast facts, right? So VA supposedly is no credit score needed, but street today effective, they need at least a 640. And then for FHA, same thing, even though technically there's no FICO score requirement. If they're below a 580, I'm just not seeing those get to the finish line. Okay. All right, cool. So we're about to jump into live rates. Any last questions foundationally on credit? Awesome. All right, so let's end this quick little show. I'm going to bring up, and we are right on schedule. Pull this up really fast. And so I'm literally going to unveil the keys to the kingdom. I'm going to show you how mortgage people make money. I'm going to show you interest rates. I'm going to show you the difference in shopping and what that means. So.
And a quick question came up. Can you add someone to a credit card in order to bring their score up?
Yes. So yes, you can do an authorized signer. Absolutely. That's a very good strategy. So that would be something we do in a what if simulator. Again, before you add debt, take away debt, we for sure need to run a simulator first to see what impact that'll be on that person's score. But yes, that is potentially a really good way to do it. So,
okay.
All right.
FICO versus credit bureaus.
Well, FICO is a trademark name or definition of the score. There are 3 different credit bureaus, and those are the credit reissuing agencies. So there's Equifax, Experian, and TransUnion. Okay. Hey, can you see my screen now with a whole bunch of interest rates and all that?
Mm-hmm.
Okay, cool. So everyone knows, right? It's even on the settlement statements at the end, how much you all make. Everyone in the world knows that you're getting 6%, 3% to each side, usually, sometimes. 5% if it's dual agency, right? With compression, now I know it's more like 2.5%, 2% depending on the transaction. Everybody knows it. But did you know how we make our money and where it comes from? Most don't want you to know. Well, it's just kind of hidden in the interest rate, usually called lender paid. On average, we make 2.5% to 2.75%. So almost the same as real estate. It's just kind of hidden here in the rate. I won't get into why, but sometimes some banks feel like they need to make 5%. And that's why you can see up to 1% higher rates, depending on the transaction from lender to lender. They just need to make twice as much money. For us, and one of the reasons we're voted number 1, we just charge less. And you can kind of see this 2% right here, kind of like Costco, just charge less, do a higher volume. I know real estate, some of your bigger teams are doing that too. They're doing a reduced fee, but they're trying to do more volume. Just my model. Okay, so let's look over here. We're doing a 30-day lock. We're doing a purchase on a stick-built home, 780 FICO score, so the very top tier in terms of credit, 548, 250. So in case you're not aware, that's the new conforming loan limit. And here's bonus, not part of the paid programming, right? Every time you add a unit, that conforming loan limit goes up. So not a jumbo loan. So as an example, if they're buying a 4-unit, it's almost $1 million. So the conforming loan limit, only 5% down, amazing rates at 20%, no MI, almost $1 million at 4 units. So just a lot of bankers don't even know this. So please know it. Every time you add a unit, you have more leverage available or a higher loan amount. But today is 548, 250 for one unit. Because it's a conforming loan, they're putting 5% down, you know, about $27,000 conventional, right? And it's like, okay, go. So right now, I've got a bunch of fake news, people talking about 175 to 199. You could, it's only $53,000 in cost. Does anybody want to pay $53,000 for a 175? No. And literally today, somebody with a 780 FICO score, 5% down, is trying to get charged at 5.125%. Some broker or lender, somebody feels like they need an extra $33,000 of profit. Okay, fine. So you see how it's green right here? And here, I'm gonna just do this. So we're looking for where the greens basically stop. There we go. So as of right now, at 3.125%, because I'm only charging 2%, if this borrower took this money, I would have to give them $2,000 towards their closing costs. Okay. Now, just showing real quick. So it happens to be Rocket Pro TPO, used to be Quicken Mortgage on the wholesale money. They happen to be winning the scenario at this second. It changes every 5 seconds who's winning. And then if we went to Sierra, it cost them $400 more. And if we went to Plaza, it cost them $1,000 more. And then if we went to PRMG, $3,000 more. And if we went all the way down to UWM, it would cost almost $4,000 more today. So depending on what lender I choose, I can make more or less money. Now let's look for sales. So 0.4%, 3%. Nope, we go 299, 2875. And then really today, the end of the sales would be 2875. So if we're analyzing money, so for $4,700, someone could buy it at 2875, and they would save about $90 a month. Okay. Also today on that same scenario, you're probably going to be hearing a lot of 325s and 375s. They just got to get a little more profit in there for their own model. Okay. So 780. So let's do this. We're going to jump into some speed now. Back over here, new share, desktop one. Let's do it this way. Sorry, you presenter view didn't look well, right? All right. Play from current slide. We're going to share the other screen. There, we're back. All right. You can see it now again, right? The market alert. Cool, thank you. Okay, so we just looked at these live. So I know you're real estate. You're like, I don't care about FICO scores and interest rates. Show me visually. So we're going to look really quickly at the difference in money and how credit will impact. And then I'm going to show you how much house it means, right? Most important, you're like, just show me how much house that means. So thank you. And even though it's dirty, it's disgusting, the Department of Justice, the FTC, the DOJ is talking about it. There's this huge battle going on between Quicken or Rocket Mortgage and UWM. And there's a bunch of antitrust talk, and it's sort of dirty, and I won't get into the why of the politics. But the good news for you and I, and for your clients, is when there's battles or wars, we see sometimes pricing drop. And even though rates have jumped consistently over the last 3 weeks, this little war is a really good thing. We're seeing pricing drop below where it should be based on the market, okay? And it used to be 780 was top tier, okay? Well, now 760 is the same difference. So at 760, they can get a 299. They'll still have to pay them $2,600 because the battle 740 is almost the exact same, $30 difference. Who cares? Effectively, 740 is now the same as 780. Like, thank you for your battle. But then the second you go to 739 credit score wise, right? Your utilization off, you pulled your credit, you closed something new, whatever was wrong. We just jumped to 3125. We just took over 0.25% higher rate in cost. The second you fall below 720, so 719, you just cost yourself same rate, but look, $2,600 more. That loan became $2,600 more because of one FICO score. And now it's going to get really impactful. We're still 3125. So thank you, price war. Used to be if you fell below 700, you're going FHA. Now there's almost no change. But check this out. The second you hit a 679, 1 point below 580 or 680, it's 3.5%, not 3.25. It's $1,400. So literally, if we go from 760, so here, I'm keeping the same payments. That way you can visually see, right? So if this person's at 760, they only have to bring in like $25,000. At 740, remember there's almost exactly the same, only $300. 720, $8,000. Either they're buying $8,000 less house just because they hit a 739, or they have to bring in $8,000 more cash to close. Same payments across. 700. Now we have a higher rate. Now they're dropping 32 grand down, or coming in at a lower, purchase price of 540. 680 wasn't too bad, but check this out. The second we hear 679, they're bringing in $58,000 to buy the same house. Not real, right? So they're just buying a lot less house. You're buying like $30,000 less house. So remember, if someone hits a 679, and this is what I challenge you, is never accept no. If you have a person that's told they can't buy and you find out it's because of credit, no way, I don't accept that. There's probably a way to do it. Remember, 4 out of 5 people can have it improved. So when we get that person that's a 679 and they're saying, man, I'd sell my house today, but you can't find me anything good. My max purchase price is only 4. I need at least 450. Oh my goodness, you're 679. Let me call your mortgage person real quick. Dude, we got to get this credit score up. 1 point means this guy can sell his house and buy. It means I'm getting 2 transactions. It means his dream is going to come to fruition. Like, it's a win-win-win. You get one of those too. Let's go. Okay. We'll race through it. So now we're going to look at the difference in VA. So conforming versus VA. And so just if someone has service-connected disability, there's no better loan. It is a benefit, not a loan. You'll see the rates are so shockingly better. No 5% down, no mortgage insurance. You can buy a lot more house. And so that top tier isn't 780. It's not 760. It's not 740. It's not 720. Literally starting at 700, just a 700 FICO score. I'm saying 275 today. And with the 275, I have to pay them $5,600 towards their closing costs. 700 credit score, just average, 50 percentile. It falls to 680, still getting a 275. I'm still giving them $3,500 towards their closing costs. But again, for that 1 point, so they get a 699, they just lost $2,000. Hey, let's bump them up a point real quick, right? 660, still here in 275. 660 is getting a 275. No money down, no mortgage insurance. Yeah, there's a little bit difference in how much cash I can give them, but I'm still giving them almost $3,000 at a 660. Now, the second it falls below 660, a 659, really effectively, we're now a 3125. So the second they say 659, and I have this, I have a couple 659s and 654s, I'm getting their score up. We're not taking, a 3125 and $5,000 more money to close a transaction. Not happening. I'm going to get you a slightly higher score. And so visually, so you can see it, money, right? Show me how much money. So here's that 770, 275. I give him 56, 680, still give him $3,500, $2,900. But if you check it out at 640, way less leverage, like $26,000 less leverage, plus $5,000 more cash to close. That's a $30,000 loss. So again, if I get a 659 at VA, we're getting them 1 point, we're getting them, $30,000 more leverage. So before we go into break, like we're done with the first whole 101 in live rates. Any question on live rates? I know I've literally had every realtor I've ever shown this the first time. It's like, I've never seen how you make your money. I've never seen rates. I didn't know that literally shopping is such a big deal. Like I didn't know it was a $10,000 swing. I didn't know it was potentially 1 full percent interest rate just by shopping and how much you charge. Any questions on this at all? Foundational or live rates real quick before we go into a quick 5-minute break?
Do some lenders not use the options that you showed?
Yeah, most don't. So just to understand, if you call a bank They're one lender, right? So you could go, like if you notice on the one scenario, Rocket Mortgage or Quicken was a number one lender, wholesale money, at least in that channel. You could call Quicken Direct. They may or may not be the number one lender at the time. Statistically, though, they're not going to be. So it'd be like if you went to Kendall to buy a truck, they'll probably give you a good deal. They've treated me good in the past. But if I called every single dealership in the state of Oregon, I'm probably going to find a better deal. So if you go to a direct bank, they only have their money. I'm a broker, so I get to shop, and I just wanted you to be able to see visually.
How do you shop without it affecting your credit score?
Okay, so either A, you go to a broker where I can shop the entire nation for you and find the deals and be like, there's the cheapest money at the second for you. Or you make sure if you're going to call 2 or 3 or 4 or 30 people yourself, make sure when you do it within that 30 days that people are pulling credit. So it doesn't drop your score.
Can you give examples of which companies are brokers and which are not?
I don't think we have the time. No, it'd be like saying what real estate agencies in the state of Oregon have different models. It would take too long. What I'd say is if you have questions, Cascade knows, right? Like, so let's say you can reach out to Cam, you can reach out to Beth. In terms of relational, like they're the experts. They know how to pitch you with the right people who do various things. And I'm not suggesting brokers are better. We're better at certain things. Like today, we're better at VA and vanilla conforming. But big banks are amazing at jumbo loans. They're amazing at construction loans. Credit unions are amazing today on 0 down, 1%, 3% down, community reinvestment loans. Like every bucket of money is so valuable and needed, and each one of us is better at something. So please don't hear me say, I'm not saying we're best at everything. Just VA and vanilla conforming today. So, all right. Okay, so here we go. If you love a realtor, raise your glass. If not, raise your standards. 5-minute biological texting, call someone important, make some money break. We'll see you in exactly 5 minutes. So we got like 30 seconds till we start the live show again. Please start coming back.
We got a quick question.
Okay, cool.
Any tips for a 19-year-old who's just starting to build his own credit?
Yeah, so, okay, so 2 things. Hopefully he's already banking with someone where they already know him, right? And he's depositing his checks every single month. He should try and get some overdraft protection. So that's just, $100, $200, $300 that sort of protects his checking account in case it ever goes NSF, non-sufficient funds. Depending on the bank and that person, they may or may not allow that to happen immediately. If not, they want to get a secured credit card. Secured. So basically, same thing. You go through your bank, you give them $300, they hang on to your $300, and then they'll lend you $300 of your own money. And that's a method where you sort of build credit. If you've been a good boy or girl, after 6 months, they give you your money back. Yay, you have a normal credit card. Lastly, I don't encourage people going into debt, but for someone who has blemished credit and is trying to come back, Harry Ritchie's jewelry. Buy some nice jewelry for somebody. They have a layaway program that for whatever reason they report. Smart marketing. Everybody just knows you go to Harry Ritchie's, you buy jewelry. If you don't have credit or can't get credit, they'll do layaway and it establishes a credit record for you.
A question to follow up on that, Chris. I have heard of people putting their, minor teenage children as an authorized user on a card to help build that child's credit. Is that something that you find effective? Is that a real thing?
Yeah, authorized users. Yes, that is another method. You can do it as well. Yep. All right. So incoming, here's the new stuff. Here's the fun for all of you people who've been in the industry for a while. Been like, please give me something other fundamental. This is for you. It's incoming. All right. So we just had a FICO score change, and kind of like in real estate. Remember how every 5 to 7 years on average, someone would move or sell their home, something new? Well, FICO follows that trend of every 5 years, 5 to 7. So a huge change back in 2009 with FICO 8. It was a big deal. 2014, we saw FICO 9. Who cares? I don't think anybody even really ever talked about it. And just in 2020, we went to FICO 10 and FICO 10T. And the T is incredible. Like this, it's the greatest thing that I've seen in 25 years, literally in terms of credit reporting. It's amazing. So I'm really happy to share it with you. Now, using all the same fundamentals we talked about in the foundational thing, going to FICO 10 is even more impactful. So if you have high credit, you're probably going to be even higher. They now can tell, let me back up, with interest and credit, people either make interest off their credit or they pay interest. So what I mean by that is some people allow themselves to have a balance at the end of the month, and they're going to pay someone else interest every single month for use of their credit, right? So you have to pay interest on that credit card every single month. That's not a good debt. That's not like a house. That's not an appreciated asset. That's not something you want to leverage because it increases your ROI. This is bad debt. So that person who has credit card debt and keeps paying out money every month for interest is paying interest. You should be, and I hope you're at a point where you get to really good credit. I make money off my credit every month, right? I get 1%, 2% back. I get flight miles back, and then I pay off my credit every single month. So the people that do that, and one of the questions was, hey, what if you charge your account and then pay it off and then charge it back up? For those people who pay off their balances every single month, we have a much higher score now. So before, it was a moment in time, just a snapshot, and so critical that we hit at the right moment. You'll see with the 10T, doesn't matter. If you are a person who makes money off your interest and you don't carry a balance at the end, your score is going up. They know what you're doing. You're gaming the system. You're supposed to do that. Now, for people who have bad character, who consistently miss, who have, just are consistently not paying back, their scores are going to drop even more. They're saying, okay, we can see what you do, or we can see that you consistently rob from Peter to pay Paul, and you're just shuffling your accounts because you're barely hanging on. You're making it, but we can see you're in trouble. That score is going down more. If you miss, it's a bigger deal today. Saying, hey, if you miss, it's a big deal. And credit card utilization is even more. So, okay.
Chris,
Yeah.
When paying, does paying more than one time a month help your credit score?
It can. Remember, you will be dropping utilization. So yes, depending on the moment in time and the snapshot that's going to happen, I would say if you drop your utilization, yes, it'll help your score no matter what. Paying it 2 times throughout the month really won't, versus 1 won't really affect your score anymore. But where you potentially could get out of debt quicker is on an installment debt. So for example, if you lowered your balance, so if it was like daily interest as an example, if you did principal reduction, you're then accruing interest at a lower balance. So for people who make half payments on certain installment debts, yes, if they're actually lowering your balance, then you're accruing interest at a lower balance. So yes, making payments twice as often will help. Also, if you get paid every 2 weeks, then that means you're paid 26 times in a 52 year. You'll make 13 payments instead of 12. So if you're paid every 2 weeks, a great method is to pay half payment every 2 weeks. You'll make an extra payment a year, cut off about 7 years off your mortgage. So great question. Okay, so for the person that was saying, hey, someone with no debt, never established credit, what do we do? And this is real. I removed all the privacy information out of it. I literally just had this, right here, where someone didn't have any credit. And with 10 and 10T, now we can start turning in our credit cards, our cell phone bills, our lease bills, our utility payments, and establishing a credit line. And this could have been done before. Let me back up. So if somebody has no score, and that happens sometimes, literally no score, right? That's not a lost cause. We can do what's called alternative trade lines, do what basically this is showing, and create a credit score. I need at least 3 trade lines, phone bill, utility bill, lease agreement, and then we can create a score. Okay. So if someone's never paid anybody, 19 years old, I've got a couple friends that are military that are just anti the system, no credit score. This is the method we use. Now, sometimes we have people who have no credit score because they've never paid anybody, right? Horrible character, like never paid anybody back. There's literally they're like, we had nothing positive to even say about this person. I got nothing for them. They have a track record of not paying them back. Of course, they're not going to pay their house. So that I can't help. But this is a real example. So today, what's great if you have people that need to establish credit, they can proactively start turning in their bills and establishing that credit. So someone doesn't have it when they're going to their bank and they're getting their account set up for their $100, $300, they can start self-reporting and having a credit score established. So that's part of 10T. Super cool. Any questions before I jump into trended data? Really, I mean, it's more amplified of what we had from the past, really from FICO 9 to FICO 10. Good people are rewarded even more. People of poor character, at least in terms of the bills, are penalized even more, bottom line. Trended data. This is the most amazing thing. Like, it is humongous. I've used this to win $1.5 million in business in 1 month alone. I turned $1.5 million of no's into yeses because of this very thing alone. So before this, I had a snapshot in time of right now on you or me. And now I get a 24-month history. I get to see trends. And so we're all self-employed, and some of you are business owners or principal brokers, or you run real estate agencies. And I don't know about you, but trends are huge, right? Like, I don't want to look at what happened yesterday. I want to look at what happened all year. I want to see what's happened in the last several years. Like, ice cream is more popular in the summer. Gas goes up in the summer. There's more homes on market in the summer, right? People want to try and get into their house before school starts. We know it slows down in the winter. Those are trends. So with trends, we can see a lot more of who a person is. Kind of like with Cam and I, if we could see we've always paid back and forth perfectly, but I missed once, he's a pretty good dude. But all we knew is yesterday I didn't pay Cam back. That dude's terrible. Trended data lets us see 2 years. All right, so visually, here's what we used to see. Man, this guy has a maxed out $42,000 card just about. He made his payment this month, but I'm freaked out. He has $37,000 against a $42,000 card. Oh my gosh, his utilization's crazy high. Terrified of him, right? Trended data. Now, he's only had this card for 18 months. But here's where we started from 18 months ago. He was almost maxed at $41,451. Every single month, he's chunking that thing down. So in 18 months, it's down $4,000. Is that somebody struggling? No, that's somebody thriving. He's throwing extra money at that account every single month. So on this snapshot, we're like, not only can that guy handle that account, but he's winning, versus I'm a little scared of him. He's got a credit card that's maxed out. Can he afford life? That's trended data. Okay. Yeah, we'll come back to it in a second. So who wants to be my best 3 friends on the call today? I know we got a few. Nobody. I'm giving away $10,000. So first 3 hands that go up. Okay. Cam's hand went up first. I saw Beth's eyes went up immediately when you heard 10 grand. And then Cam, who was the first person on the call?
It looks like Jackie Cowsill. He's got a hand raised.
All right. So my 3 besties, we're lifelong besties, the 4 of us, right? So there's Cam, there's Beth, and there's Jackie, and there's me. And I know this, it's a story, so it's not real. It's really far-fetched each phase, but you'll get it. So imagine on the same day, Cam, Jackie, and Beth, well, hey, Chris, we want to borrow 10 grand from you. And I'm like, that's crazy. I just posted on Facebook today. I had 10 grand to lend out. You all are coming to me at the same time. We're best friends, right? Like, we've known each other our whole lives. We grew up together. Like, how do I make this choice? Can I just give you $3,333 each? No. Beth's like, I want to open up a real estate agency. Cam's like, I'm going to pay off some bills. And Jackie's like, I'm just going to go travel the world. I'm going to have some fun. It's either 10 or nothing. Okay. So how do we make the decision? Do they like arm wrestle, leg wrestle? Do they fight? Like, how do we choose this? And they're like, let's do it off business. So you see this credit score 700. I pulled credit in all 3 of them. So Beth, Cam, and Jackie all have 700 credit scores. Now what? Roxanne, like, how do we pick this? Well, in the past, they don't have 700 credit scores, but because of trended data, help me pick who I should give money to, okay? So we got Cam down here. Sorry, Cam. You're the balance builder. He's this guy, and he's going from almost no credit card debt to grabbing a bunch of debt, paid it off a little bit, grab more debt, paid it off a little bit. And he actively, over the last 2 years, has gotten more and more and more and more debt, right? So he was like a 780 before, he's only a 700 now. And with trended data, they're like, I know he would have been a 700, but his score is actually degraded. He scares us. We can see he is not winning at life today. Now, the reality is Cam may have, acquired 3 different real estate agencies, gone from 2 people to 50. He may be killing it, but we don't have those conversations in credit. But at least we can see that trend, right? So Cam is he's constantly getting more debt over the last 2 years. Okay. Beth, on the other hand, is the steady user. She's been in the industry forever, has a good gig. She'll close a couple transactions and then she'll travel for a month, right? Close a couple transactions to make enough money and travel for a month. And here you can see, pays down the debt a little bit, plays for a while, pays down the debt, travels. Like, we know exactly what's up. She can handle her debt. And then Jackie is killing it. Like, she is having an amazing 2 years in real estate, right? Like, she had a bunch of debt starting her business and coming in, we're saying, and then is just destroying it. And so she is winning consistently. If it was your 10 grand, you liked all 3 equally, who should I lend to? Jackie, Beth, or Cam? Who do you say? Cam. Cam raises his hand. What are the comments saying?
I think Jackie.
I know, of course, right? Like, that's trends. Like, over trends, we know Jackie's winning. Jackie's the better person, at least truly from a business standpoint, to give money to. That's trended data. So let me come back to this one real quick. So $1 million transaction that I turned to no into yes. And so I'm trying to give you info in case you ever have a client, you have this conversations, and you can go back to the mortgage person. So and think 3-legged table, right? So I've got a client that has $1 million commercial building, and I'm refinancing it. Incredible, 50% loan to value in terms of from the collateral leg, like as solid as you can get, right? Solid. The guy has really good credit too. Solid. The problem, he's self-employed, like you and I. And I don't know if you know, lenders are terrified of self-employed today. And the reason why, just the understanding is, there's obviously a backstop on unemployment and additional funds right now due to COVID for W-2 people. It's not as easy for us to get our hands on money or unemployment. So without that backstop, there's more risk. So just lenders are terrified of us. Just understand why. So they're terrified of this guy, right? They're saying his adjusted gross income should work. I wouldn't have submitted without that, but they're slashing in half. Literally, there's lots of lenders slashing self-employed income in half because they're scared of us at this point. The economy, environment, I think.
So a good question here is, so now with the new FICO 10, will all lenders be looking at trending data, or something that we should be asking them to look at if things are going?
Yeah, I believe so. So I can't speak for every lender, especially the big 5. The big 5 do whatever they want. The Bank of America's, the Chases, all of them, they do whatever they want. They'll pull 1 FICO score at the beginning and then 3 at the end sometimes. But yes, most everybody, we should see FICO 10 or FICO 10T for everybody. Most everybody should be on it now. So, but again, not everybody understands it or knows how to leverage it. So just like in real estate, there's better and there's less skilled people in the industry. So, so in this one, the guy was winning, right? Thriving. His AGI worked. We're trying to slash it. And I'm like, okay, hold on. First off, this guy has $70,000 more inventory. That's not an expense. I can prove, show you, and touch. He's winning. That's $6,000 more per month. And so we got really close. And the underwriter's like, I just can't get comfortable. I think he's failing. I'm scared of his income. Okay. So what we did is we went back to trended data. So I literally over the last years proved this guy was not losing in the expenses, right, for the business. He was actively paying down at $3,000 every single month extra towards his debts. So not only did he make enough that they were scared about, he put $6,000 into inventory and $3,000 towards credit card debt. He had an extra 10 grand per month. So because of trended data, I took that scared underwriter and said, no, I can prove to you he's winning. See, every month he is stronger and stronger and stronger. This transaction, this deal is a no-brainer. The 3-legged table, incredibly strong, incredibly strong. He's truly incredibly strong. Get over your concern here. Even if you wobbled a little bit, that table stands. Let's go. And so that transaction was closed because of trended data. All right. Because of trended data, remember, those of us who leverage our credit, we make interest off our credit, 23 million more of us will be super prime. The highest tier so we can leverage more house. My wife is one of those. She's a professional shopper. Like literally every day buys, I see some hands from some people too. Like literally, that's what she does. Think Flipper, but she goes out throughout the entire state and she buys purses and accessories and clothes and anything she thinks is beautiful and cool, and she sells it and makes money. So her credit score before trended data would go from 800 down to 700 because of utilization. Mine just stays at 830, 840. The thing for us, the last 2 times we bought a house, I had to drop her off the loan. Because when we pulled credit, her score was a 7. It would have been 1/4% higher in interest rate. I could have bought like $30,000 less house or had a higher payment. Thank God I make enough money, just dropped her off the loan, added her onto title only, a non-borrowing spouse. If it was VA, a non-participating spouse, so not on the loan, but on title, right? Has ownership. But most borrowers need 2 incomes to make that happen. So if I just drop the one spouse, we're in trouble. So with trended data, they can see my wife goes, leverage your cars to get the 3% back or the flights, and then pays them off every month. Her score now consistently stays super prime as opposed to going from 700 to 800. So now she fluctuates some, but at a much less scale. Super exciting. Not only can we leverage it to turn more no's into yes, but we're going to see more people that deserve more home get more homes. All right. Like with every rulemaking change, though, there is some unintended consequences. So here's the things you should be afraid of. Be very afraid. Medical debt now doesn't hit credit reports for up to 6 months. You won't find it necessarily on the prelim at the beginning. A lot of times we don't see it to the last credit pull. And the hard thing is they're going to suppress it. They're suppressing collections. They're suppressing non-payments. So then when we pull that last credit report, so remember, lenders pull credit at the beginning and at the end, right? They're going to make sure they didn't go out and buy a brand new BMW, take on a bunch of debt last day or the day before. We're going to see, and stuff sometimes hits now that wasn't before. So moral of the story, just show us a little bit of grace. If you've got a person that always performs, that has, they always close the transaction, you know you can trust them, and then something weird hits the prelim at the end, it could be because of this. It's just like on prelims, you know how they date down, they pull a report at the very end to make sure no judgments, no liens, no encumbrances hit the last second. We do the same thing with credit reports. So just know when they do that, sometimes now we're seeing maybe 1 in 20 or 30 times something show up on the prelim at the end, something show up on credit at the end. This is why it's just being suppressed.
How fast is credit updated?
Every single day. So it's not as fast as mortgage rates or the bonds or the stock market, but daily they're going to have a new credit score. So, all right. Any last questions on credit before we jump into our case study, Dirt Bike Dummies?
You by chance have any sort of a tip sheet that they could share with clients to make sure they're doing the right things?
I don't have one specific to credit. So I would say if something is desired, I could easily make one. So I'll make a note, a tip sheet for clients. Okay. And is it specifically for credit? Because obviously we don't want them, like another one that sometimes I've had happen at the close. You know, sometimes you close and then you record the next day. Like you sign documents and then you don't record the next day, right? On transactions, sometimes not same day. I've had people quit their jobs. So like they sign their documents, yay, I'm getting my house. That afternoon, yeah, that's like, yeah. And they quit their job. And so the next day when we go to fund and record, it's like, well, sorry, they don't have a job anymore. They're not getting a house. So a good tip, if you do your own tips, is don't quit your job at least until after you have the keys. So that's a good tip.
A couple questions on the medical debt concerns about possibly like not knowing until it's too late, or working with buyers who have medical debt and kind of what to do.
Yeah. So what it says, really, unfortunately, it's just one of those that I'm just letting you know that the track record to be on there is longer, and And it's a good thing, honestly. Creditors used to be able to throw stuff against you just with very limited information. And so now it's saying, hey, you tried to slap that only, you only had 3 pieces of info. In order for us to validate it, we need 6. So I don't think it's something that you really can be proactive about. We have to be on the mortgage end. It doesn't impact most transactions. Really, the purpose is to let you know if something sometimes shows up and you're like, what the heck, escrow? How did you miss a judgment at the beginning and then all of a sudden you found a judgment at the end on your date down the day of? Well, it's not their fault. Judgments are being suppressed for up to 6 months for civilians, for veterans up to a year. And so again, if you've got a good escrow company, if you have a good mortgage person, just know some grace. If something weird pops up at the end, just know it's because of one of the unintended consequences. Great title company, great broker. I'm sorry, there's just new risk that you can't plan for sometimes. Cool. All right, so dirt bike dummies. So this is the live case study, and we're going to look at rapid rescoring. One of my favorite things, I use rapid rescoring every single day. So real estate and mortgage need to be a team, right? Like huge compliments to both the realtor and the banker, and I happen to be the banker, so I'm bragging about myself. We did a great job, but this realtor really did. They supported me great. It was a year of pain to get their credit score high enough. It was 4 months of shopping rural properties because it's such a competitive market. So it's almost a year and a half, and we finally got their score high enough. We finally got them in contract, and we did it as a team, like all the time. Like, don't take out that debt. Don't buy that new car. You know what I mean? Just like tag team them, right? So we told them, like, no, you can't buy a new washer and dryer. You don't even have your house yet. No, you can't get a fridge for 30% off. You don't have a house yet. Because they kept asking this like every week, right? They're trying to buy stuff for a new house. They don't even have a house. Okay, now we're in contract. No, you can't get dishes because there's a sale at JCPenney's. I'm sorry, you can't put that on card. And here's what we said. Both of us reiterated. Thank you, agent. You cannot buy anything that goes in the home. Now, what did I do wrong? What did they do wrong? Anybody that's been in the industry for a while? Let me give you a hint. If you have children, how important are your words? So here, let me use an analogy and maybe you'll figure it out. So pretend you're going to go to a wedding, a really fancy wedding. You're all dressed up. You're both dressed up. Your kids are just dressed to the T's. And you're walking there, sunny day, and you see a humongous mud puddle. And you have little kids. What are they going to do? They're going to run through the mud puddle, right? They're going to get wet. They're going to get messy. They're maybe going to get you wet and messy. And you see it. And if you say, do not run through the mud puddle, what are they going to do? They have little kids. What are they going to do? You know, they're going to walk through the mud puddle. They're going to stomp through the mud puddle. They're going to stop, drop, and roll through the mud puddle because you said don't run through the mud puddle, right? What you have to do with kids is understand, don't go near the mud puddle. So what was my mistake when I said don't buy anything that goes in the home? Anybody? Any guesses? Remember, we're buying country property, 5 acres.
Someone said they went and bought a lawnmower for outside the home.
Okay, so Cam knows, right? Like, it's a rule. I don't know if you're new in real estate, if you buy rural property, you have to buy one of 2 things. It's a rule. It's a country rule, right? You have to buy a riding lawnmower, tractor. It's a rule. Or you have to buy dirt bikes and an ATV or quad. You have to. Like, if anybody's ever lived on acreage, which I have, you have to. You have to buy a tractor or quads. It's just a rule. So 5 acres. So the reason I call this story my dirt bike dummies is my dummies bought dirt bikes because dirt bikes don't go in the home. I should have said, don't buy anything just like children, right? They're simple people. They're smarter and simpler people. I'm not judging them, but these were simple people. I should have chose my words better. So for you all that are protecting yourselves, don't use the phrase in the home. They bought dirt bikes and they don't go in the home. So learn from my pain. So I got 2 dirt bikes bought. It went on their credit. Their credit score plummeted just before we're supposed to close. What do? Okay, PBs, okay, you all who've been in the industry for a while, when you hear all of a sudden, remember that call, right? The perfect day. This is literally the story at the beginning. Driving, listening to your jam. I'm going to close that $3 million transaction. Ring, ring. Dirt bike dummies. Struck again. Credit score dropped. What do? Cam, any comments from any?
Can you take them back?
You could potentially, right? You're going to take a little bit of a loss. It's a nice thought, take them back. But this is real estate, right? And so it's going to take a while for their credit score to come up, because it could take a month to 45 days for that new credit score to come out from the place they bought the bikes from. That'd be like saying there's a wall in front of us and it's real estate. You're just going to walk around it. We don't have the time. Like, you got to scale that wall, right? You have to smash through it and pretend you don't see it and just drive through. It's real estate. So, all right, let me do this with you. So what happened is, remember that scenario, middle score again is a 622. For these dirt bike dummies, we need a 640. 622, oh my gosh. So I'm going to give you the troubleshooting order. So just like on your phone, right? What's like, if your phone's not working, what's the troubleshooting steps? Is it even turned on? Am I logged in? Restart it, right? Like, there's certain things that you do every single time. If it's a desktop, is it plugged in? Is it even turned on? Restart it. Especially if it's Apple, they just work. Just restart it. So if ever you have a transaction and you get that no, that it's not going to close, that they don't make enough money, or they can't buy enough house, here's the order that I do it. Here's my troubleshooting order from easiest to least. So first off, rapid rescore. Not a new lender, not a new program. Like, I gotta find those 20 points. I gotta get that 622 above a 640. I don't accept this no. Remember, no to no. There's always hope and there's usually a solution. Okay? Rapid rescore. Super fast improvement in credit score. Second of all, maybe we bounce loan products. So they fell from a 680 to a 660. That sucks, Mr. and Mrs. Buyer. I'm sorry you bought some dirt bikes. I told you like 75 times not to buy anything. You saved 10%. I know, it was a good buy. Here's what it means. I'm bouncing you from conforming to FHA. Good news is you still get your house. Bad news is you have lifetime mortgage insurance and your payment just went up $150 a month. I'll try and refinance you later. You got your house, right? So at least it's not a no. They're still getting their home. They're just paying because they bought the dirt bikes. So rescore, alternative program. Sometimes your lender's just like, I don't have this, no solution. Different lender. Hey, it's okay. You're still my fave, but your minimum FICO score is 700. I know I've got XYZ lender over here. My number 2 goes down to 660. It's not a no, it's just wrong lender. So first, improve the score, different product, go to someone else. And then lastly, bridge loans. So from a true bridge where you leverage both properties potentially, maybe money from family, private money. Every person on here should have a private money lender, in my humble opinion. Every realtor should have a private money lender in their back pocket. All cash, retirement loans, and I'm not a CPA. Be careful. You could have some sort of tax ramifications if you pull money out of retirement and don't put it back within 60 days, or seller carry. So literally, remember that no that we got, because it's a 622 dirt bike dummies. I just gave you like 10 different ways you could potentially get the finish line. Rapid rescore, alternative product, alternative lender, bridge loan, money from family, private money. Oh, and then money from family, write down self-directed IRA. So a lot of people don't have, say, $500,000 cash, but they may have $2 million in the stock market. And some people are a little afraid of the stock market and a double dip and not having a true recovery at this point, especially if they don't extend the SLR and some other stuff. And some people will flee out of the stock market. Well, they could do what's called a self-directed IRA, no tax ramifications, lend out of their IRA. They could make that loan to their kids. Or the kids could pull money out of their IRA and do a self-directed IRA loan themselves. So there's some cool ways to leverage retirement funds. But again, no to no, there's usually hope. There's always hope and usually a solution.
Hey, Chris, can you go a little bit further detail of the rapid rescoring and how
That's
that
what we're
works?
doing. So thank you. Hey, so whoever said that, that's the last 15 minutes of this course. We're literally going to dig into rapid rescoring. Again, thank you, Credit Plus, for letting me leverage your rapid rescoring thing. It's not specific to them. If you haven't heard of it before, it costs me money. A lot of people don't want to spend the money on the if they're going to get paid. Okay. Also, you have to be technologically sound. So it's just, you got to find a lender who was willing to spend money and maybe not get it back, and that has the ability to do it. So, but everybody should have the functionality. It's through whoever you use that reissues credit. Now, there's two different models. There's a what if simulator. This one I used to use exclusively because I was smarter than the computer back in the day. People used to beat computers in chess. They don't do that anymore. AI is so smart. So I battled, and we'll see if I won or lost this time. In general, most people use this to remove a collection, to add an account, to remove accounts. So this is how I would say, hey, okay, you want to close 5 accounts. What's that going to do to the score? This is how I look at it real quick. Oh, if I did you as an authorized user, this is how I would check. Oh, we just wait 30 days. This is how I check. But in this case, I said, hey, I need to get to at least 640. Remember, we were 622. I did it. I was able to do it. I got it to a 647. Here's all their trade lines. I chose these two. And so what I did to make it work. So a no into a yes for the dirt bike dummies, right? Not a no, not you drive into a telephone pole. It's happily ever after, perfect day. Discover, we're going to pay down from 3,500 down to 650. So about 2,900 bucks. Sears, we're going to take from 1,100 down to 0. Okay. So for like, would that be 29 plus 11? So for $4,000, you get a yes. There was me. Okay. Let's see how the computer did. So on the computer, what's cool. Actually, let's go back a couple real fast. All right, there. So this. So remember, we need a 640, right? So pretend that this was already a 660. If this Experian was a 660, I wouldn't even mess with it. I would try and raise these scores, okay? But in this case, because I have a 614, a 627, and a 622, I gotta get at least 2 scores up above 640. So I'm just gonna spend the money on all 3 of them. I don't care. So in this system, you just say, hey, let's play with Experian, let's play with TransUnion, let's play with Equifax. 2 different ways. Sometimes they're like, I only have 500 extra dollars. Every other dollar is going towards the down payment. Every extra dollar is going towards closing costs. I only have 500 bucks. Or mom and dad are going to gift me $1,000, right? So I put 500 or $1,000 in our disposable. In this case, I was like, I don't care what it takes. I know you have family, dirt bike dummies. We got to get 20 points. Go. So it did it. I'm a little pissed. It found 27 points. I only found 25. So first off, it found 2 more points, and it did it for only $1,411. So it beat me by like 2,600 bucks. So mine was only 25 points for $4,000. So the computer beat me. I don't even try anymore. The computer wins every time now. So, and this is all we have to do. Check out this lower one. So remember how sometimes 1% equals $50,000 in house, just 1 point in credit. For only $294 to Best Buy is 10 points. So literally for $294, you could buy $50,000 more house. Or for $294, that no is a yes. For another $746, we picked up 17 more. So literally check that out. For 1,100 bucks, that person, that no, the dirt bike dummies became a yes.
Hey, Chris, are you familiar with any free versions of programs like this?
So sort of, nowhere near as robust. So through Credit Karma, through Equifax, Experian, TransUnion, each of them have their methods that will tell you what's happening with your scores and way you can impact it. Again, it's not as robust, but that's okay. At least you can see your trend. Another side note, when people run their Credit Karmas, that's the highest score. There were about 16 different tiers and matrices of credit, like auto loans versus mortgage loans. There's different scores. So every time, just know when we pull a mortgage score, it's going to be lower than the Credit Karma. You know, they're giving you products. They want you to feel warm and fuzzy. They're going to give you the best possible score. So, but remember trends. I don't care that and I use Credit Karma. It's good. I don't care that it claims I'm a 850 and I'm only an 830. I don't care. I just want to see if it's going up or down. I just want to see if someone's pulled my credit when I haven't done it myself. So I understand the tool and the trend. Who cares that it's not going to be exactly the same score for me? But just know it's going to come in a little bit lower. Any other questions on rapid rescoring, Credit Karma?
So in that scenario, you pay the $1,100 to raise their score. you have to wait another 30 days for those payments to hit?
Thank you. Great question, because I forgot to touch on that. So one method is we could simply pay it down $1,100 and wait 30 to 45 days. Will that work for real estate? Are you just going to hang out for an extra? Remember, this is the finish line, right? And we'll just extend for another 45 days. Who cares about the 5 chain transactions, buy, sell, buy, sell, buy, sell, right? They'll just extend for another 6 weeks. Who cares? No. So that's why it's called rapid rescoring. So what happens is I get the proof that what the new balances are from the borrower. 0 balance with Sears. The other one was paid down $300. And I send it into my credit reissuer, Credit Plus in this case, and I give them money to do what normally happens for free in 45 days right away. So depending on the volume, I could have a new score in 2 days, up to 7 days. But literally, new score in 2 days. We're not waiting. Money greases the wheel. It's like, here's a bunch of money. Give me my new score. That's why it's called rapid rescoring. So not just no's, but remember, when I get that, VA, when I get that 659, I'm like, I need 1 point. You have to go pay $50 down on your credit card. Then I can say you can buy 500 grand, not 430. Go. Like, that's the stuff that really in this market where everybody's trying to buy more house, that's the stuff that I'm looking at. It's not as much no's and yeses. It's more of you can buy more. You can be you're so close to a tier for $300, you're getting more house. Rapid rescoring is incredibly powerful.
Is there a place that like the average person could just go to get theirs done?
Well, what I would say is ideally your clients are being proactive, right? So they can see, hey, my score is here. Let's have a conversation. And in real estate, ideally, they're already pre-approved with me, right? Like, they shouldn't be writing contracts and driving around looking at homes before they've already talked to me anyway. We should have this conversation. But proactively, for family, for friends, for clients for the long term, hey, let's take a peek at your credit score. Wow, your credit's so close. We do need to get it up. You use whatever it's suggesting. Number one way is to pay down your balances. Remember, we know how to deal with the balances. So if it's really far out, use that get out of debt strategy, right? And then we're going to spread them out about a month before. If we're ready to pull the trigger, hey, kind of look at your balances. Let's maybe spread them out about a month before. So by the time that mortgage guy's seeing it, I got that 680. I got that 780 actually, if it's conforming. Well, all we need is 740 today, or I got that 660 for that VA person. All right. If no last questions, my commitment always is to get you guys out on time or early. So we're at the finish line. Any last questions? I have time for 2 more. Otherwise it's gone.
Yeah, I've got a question about if you open up additional equity loans on properties that you have, how does that affect your score? That is, do you have to use that equity line on a regular basis, or how do they look at that?
Yeah, great question, Dave. So taking the fundamentals as whole, if it's a brand new account, obviously it could negatively impact it. And that's just a timing thing, right? Brand new accounts typically lower the score a little bit, but it's really smart. That's one of the biggest strategies for people who want to buy investment properties or multiple properties when they did private money for 10 years. I don't want them using private money forever, right? We need to get them to where they have enough line of credit on a home they can start paying cash. And so it's a wonderful model. Grab the equity. In case you're not aware, Key Bank actually does seconds on investment properties and lines of credits. So just there's a way to get some additional leverage. But you're right, Dave, depending on your utilization will also affect it too. So if I have brand new line of credit that's maxed out, that will drop the credit score. But again, what's the goal? The reason we're getting those lines is so I can buy a bunch of real estate property over and over and over, rinse and repeat. Well, I don't care. I got my line. I'm not worried about my score. I'm just going to flip 100 houses real fast. Time for one last question, if there's any. Otherwise, you get to just start rating me. Report card.
Please explain the options available when locking in an interest rate. Example, if the rate drops significantly below lender's current locked rate for a borrower.
Okay, great question. So lock rates, it depends on the lender. So some lenders that move slower won't let you lock for shorter periods of time. Typically, I see rate locks from 15, 30, 45, 60. Some lenders will do very extended locks, but the rates typically go up quite a bit higher. the longer the lock, the more expensive it is. Because that lender's guessing about the future, right? They're hedging funds, they're guessing on money, and they're committing to what the future is going to look like. The farther you go out, the riskier it is. The greater the risk, the greater the rate. Some lenders, there's a few that are very technology savvy, can do a custom rate. So if I know, for example, my transaction's closing in 32 days, I couldn't do a 30-day lock. I might have to go to 45. With certain lenders, I literally could do, say, a 33-day lock with 1-day buffer just in case to be safe. So that's how locks work. Okay. Great questions, everybody. Really interactive. So now's the report card on me. Remember, 3 goals, right? So you get to rate me. Did I accomplish my 3 goals? So please yell it out, unmute yourself. So Beth, if you'd unmute everybody, show of hands to Cam, whoever. Did you learn anything? Did you gain at least one piece of information you didn't know before? Yes, no?
Yes.
Absolutely.
Absolutely.
Okay. I assumed as much.
For sure.
I'm a confident person. I said yes already. I marked it for you. Thank you. I thought you'd learn something.
Chris?
Now, are you going to do anything because of this, right? Are you going to just say, oh, sure, my perfect day, that's a no. I'll take that. Are you going to do anything differently because of the class today, the course of the last 2 hours? Anybody?
Yes.
Nice, nice, nice. And if anybody's a no, please contact me directly. We'll talk directly on how you can leverage it. But I heard yeses from almost everybody, so I'm going to check mark that for you as well. Oh, thank you. Okay, so for the fun factor, right? That's we don't do 1 to 10s. We just do yes, no. So I'm going to give you a choice. You know, in the past, I've had full body rashes. I've had all sorts of things, but I got to keep it new. So your choice, and you don't have to legally change your name. We're not talking legal name change, right? We're just talking on social media for the next year. So business plan 2021, what sounds more fun? That you're going to use for your profile picture, this picture right here, and you're going to have Trump for the rest of the year, whether you like him or hate him, I don't care. Just, does that sound fun to you? Or that's option A. Or B, you could listen to me speak again. Beth could have me back, right? So how many votes do we have for you to change your social media, all of you, to Trump? Cam, I know I just saw a couple people raise their hands. Who was that? Who are the freaks? Okay.
I'm not sure I saw.
Okay. And then how many people would like to hear me again do? And it was fun. They thought today was pretty fun.
Yeah.
Lots of hands.
Yes.
Oh,
Yes.
all hands. Thank you. I assumed as much. All right. So Cascade Title and Escrow, incredible, local owned. They always bring the education, right? Cam, Beth, thank you so much. Just as a testimony to them, just like never accepting a lender no, I've closed transactions Brand X said they couldn't do because they're national, right? Cascade has local underwriters and insurers. So I've literally had Brand X say, we're not going to take the time to close that transaction. We can't figure it out. It's too hard. And I've literally said, hey, Cascade, this. And their underwriters looked and said, well, yeah, it makes sense. Let's go. What do you mean they can't do it? So what I'd say is no to no. Just because someone says no means you haven't maybe talked to the right person. So the next time you have a transaction, if they blessed you in this, bless them back, but never accept a no. See if Cascade can help you close that transaction. And then I'm Chris Bettis from Fluent Mortgage. Hopefully you think credit fluently, for sure VA fluently. Take care, everybody.
Thank you,
Thank
Chris.
you.
And if you want to just send the slides over to me, I can send them out when I do the CE credits to everybody.
Cool. I'll make it happen. All right, guys, I'm going to hang on here for a couple minutes. If you have any questions, sort of post this. I know I usually have people come on and ask about scenarios. So.
And thanks everybody for coming. You can hop off if you need to. Otherwise, you can stick around and ask Chris any last minute questions that you have.
Nobody?
Nobody. Well, it's because you spoke so well and you answered all the questions going
Oh.
through. That's what it is.
Yeah,
I
totally
have a
trying to
question.
redeem yourself from this morning comments I won't bring up. Thank you.
I have
Totally redeemed yourself, Beth.
one question.
Yeah. Oh, hey, Karen.
How is it, why is it that if you're on the same credit as your mate and they always have a higher score than you or vice versa? When you
Yeah,
have-
there'd have to be, and I have seen it a couple times, exactly the same score. So there's got to be something different. There has to be some utilization. Someone had a credit pull. There has to be some variance because the matrix is the same either way. it does not influence based on race, all the protected classes, race, gender, national origin, marital status, any of those are not factored in credit score. So there has to be an inquiry, something different. So.
Okay.
Chris, can you speak to clients who are in the marijuana business with lots of cash down?
Yeah. So first off, you have to make sure the title company will actually insure it. Not all title companies will insure cannabis related. And to clarify, for cannabis, we're talking actually marijuana produced. So if it's just hemp, that's legal. There's lots of lenders, as long as it's W-2, it's just hemp, there's no cannabis related. Lots of lenders can close that conforming. No big deal. But if it's truly cannabis, not a lot of people are still doing those loans. I used to do a ton of them, private money. The reason I got out, and most private money lenders I know did, is because the attorney general in Trump's era completely about face, and not politics, just reality, about face, and basically very aggressive towards going after people with licenses in Oregon as an example. So it's just what I'm seeing mostly now is people within the industry lending themselves. So some people have sold dispensaries, some people's farms are doing amazing, and they're lending within themselves. So I'd say reach out and network within the cannabis community, and they're supporting their own today.
Does the average wage rate in given markets over another market where the wages are higher have an effect on the people that live in that market for what they can borrow?
So we say that one more time again, Delbert. I'm sorry, I didn't understand completely the question.
Well, if a person that wants to borrow is living in a low income level area where the market wage rate is lower,
Yeah.
as opposed to somebody that lives in Silicon Valley, for instance, is it going to affect what their credit score might be or what they can borrow?
Well, in terms of credit score, where they live or demographic and how much money they make shouldn't be a factor on score. But yes, I agree with you. That would influence, because now we're talking debt to income ratios, like Silicon Valley. Houses are really high, wages are a little higher. That, you're right, that could influence debt to income ratios and qualifications. Conversely, if you're in a poor community, you may get a lot of USDA. Like, in ours effectively, we just don't see much USDA anymore because rural houses have gone up so high in value to meet the income requirements. It just doesn't match anymore. So if in certain markets, I'm seeing Eastern Oregon, certain states, they're still doing a lot of USDA. So specific to what you're asking exactly, depending on your demographic or market, yes, you might have different loan products.
So demographics matter.
Yes, but not really for credit. It won't affect the credit though. So, all right, all. Well, have a blessed day. Happy Friday.
Thank you so much, Chris. We'll talk soon.
Sounds good, Betsy.
Great class.
Thank you. Truly.
Thanks, everybody.